Hello, everybody, and welcome. As we like to do every week, we like to take a look at the past week's market activity and then bounce around the market and look for something to do. Well, what a crazy week, or actually last few months we've had. So I'm going to go through a couple of things here today, and then we're going to do a trade based on an assumption. Again, we always trade based on our assumptions. We don't know what's going to happen, right? So all we can do is what do we think is going to happen, and then we base a trade because of whatever assumption we choose direction-wise. But I want to show a couple things. So since we hit the high of the market right here at the end of 2021, the market has pretty much continually just dropped down, right? It was kind of going down. The Ukrainian war had a big dive and it kind of recovered, and now it took another big dive. So what I'm going to look at here is if I use this tool, it'll show me how much the market has lost in this dive. So you can see up there it says 115 days. So essentially since the beginning of the year, the S&P 500, which is this, SPY, has lost 14%. It seems like a lot when you watch the market, but in reality, it's not that much. 15% is not a huge drop, although it seems like a catastrophe in the market right now. Can it get worse? Absolutely, it can get worse, and that's kind of the point of this exercise today. Is things have gotten bad in the last few months. In the past, meaning since 2008 crash, it has essentially gone straight up for the last 12 years, or let's say 14 years. So one little blip in the radar where it goes down by 15% seems like a lot, and in the past we've watched it recover every single time, but maybe this time is different. Maybe we're headed into a bear market. So I'm going to show you right now. I'm going to go to a 1-year time frame, and I'm going to zoom out, and you'll see if I go to where we are right now, right, there's the low. We'll do it right there. That essentially all that's happened in this massive, what looks like massive crash, is we've basically lost 1 year in the market. That's it. 1 year ago, almost to the day, we were at the exact same level we are today. So it went on this huge run for a year, and then in the last few months, it dropped. It seemed like a ton, but it really only dropped 1 year. So we're exactly where we were in 2021 in May. That's it. So remember, the market has been going up for decades. If I can pull up a time frame here, we'll go to a time frame, a longer one. We'll go 20 years. So what I'm going to do here is show you, this is the crash. Where's this 2020? Why did it not go so far back? Oh, I got to go all the way over here. It only zooms out so much. So I'll go all the way over here. So look in 2008. The market was at 67.1. Okay? The market today is at 412. So I want you to watch. I'm just going to slide over because the screen only zooms out so much. If I slide over, you'll see that the market has just continually gone up, up, up. We're just looking at this, basically this graph over the last 15 years, and look, up, 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 up. Yes, there's some blips along the way, but in the end, up, 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 up. Massive collapse here, but it rebounded again and then continued up, 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 up. And here we are today. So again, we've only lost 1 year in the market. The point of that exercise is to show you we can fall a lot further. Okay, we've only fallen 1 year's worth of increase. Can we go back 5 years? Could the market collapse to where it was 5 years ago? Absolutely it could, right? So again, the assumption we're making today, or that I'm making, is although this looks bad, in the past we've rebounded many times, I believe, again, it's just my opinion, that we're headed into a bear market and things could get a lot worse before they actually get better. So the reason I bring that up is that's the assumption I'm going to work with. So we're just going to turn this into a 6-month graph. So most of my account is based on the market kind of staying around a certain range or basically heading back up over time. So in order to counteract that, I'm going to make a trade that bets, even though the market's gone down, I usually don't follow, let's say, what they call a trend. I'm not worried about the trend. This is personal opinion that, like, hey, I think the market has a lot more room to collapse over the next 6 months, year, whatever. And to basically counteract my portfolio, I'm going to start making a few more bets headed to the downside. So how am I going to choose which one to do? So in this case, what I'm going to do is I'm going to look at all the indices. This is the SPY, S&P 500, and this right here will tell me how much it's dropped. So in 116 days, the S&P 500, as you can see, has dropped 14.44% roughly. If I go to the NASDAQ and do the same experiment, you can see it's dropped 23.58% if you look at that box up there at the top left. And if I go to the Russell, same thing. This has dropped around 24.5%. So the Russell and the NASDAQ have dropped 10% more than S&P 500. So for my assumption, I'm going to assume, since I believe the market is going to continue downwards, that the S&P 500 has to do some catching up on the downside. It's dropped 10% less than the other ones. So that's my assumption. You can assume that NASDAQ is going to drop further, the Russell. Again, you got to start somewhere. So I'm going to SPY, I'm going to the trade page, and in this case, because the SPY is so liquid, I don't mind using either this one at 47 days or this one at 60 days, whichever one you prefer. We'll just go to 47 days. We'll open this up. And if I'm going to bet the stock market's going down, I'm going to buy a put vertical. And I start by buying the put directly above where the stock price is and selling a put directly below. So in this case, it's 413 and 411. Again, 413 is the stock price directly above where the stock is. This is perfect. It's right in the middle, and I'm buying the put right below it. So the stock price is right firmly in the middle. And when I buy verticals, I'm looking to pay roughly 50 cents per dollar width. This is $2 wide, so I want to pay roughly around $1. So this is totally fine. It's going to work out to roughly 40 cents per dollar width. So I'm going to pay 40 cents per dollar width, totally fine. Buy a put vertical that's assuming the stock market's going to go down from here in the next 47 days. Tomorrow will be 46. And that'll be the trade for tomorrow. So when the market opens up, whatever this price is at, we're going to look to, again, buy the put directly above the stock price, sell the put directly below the stock price, and look to pay right around $1 for this trade in that range, 80 to 120, anything in that range. We're much more lenient on buying verticals as opposed to selling things. So that's our trade for tomorrow, and those are our assumptions. If you have a different assumption, if you think the stock market will rebound, you would actually buy a call vertical if you thought the stock price was going up from here. But again, we all got to start with our own assumptions, and we base our trades on our assumptions. So this is a long put vertical in the SPY for tomorrow, and this will be 46 days tomorrow when you see this. Hello everybody, Cal here with what I believe is an exciting opportunity. But just before we get started, I want to make sure you're aware that I do have quite a few courses up on Udemy. All the ones that are available are listed here. And some people don't know that these first three here are an actual 3-part series. So number 1 in the series would be understand options, number 2 would be basic option strategies, and number 3 would be make and manage profitable trades. Again, if you're taking 1, now you know that it's a 3-part series. You might want to take part 2 and 3, or if you're in 2, take 3, etc. And then I have a couple extra courses there as well. But the purpose of this video is because I want to get you up and trading as quickly and confidently as possible. And the best way I've come up with to do that is by offering an alert system where you see me trading in real time, making and managing my trades. So if you go to sharpertrades.com and you click on the products button here, you'll see these two pop up: Option Basic Alert and Option Pro Alert. They both contain the alert system. The only difference with the Pro is it has a 13-course bundle. It has every course I've ever made, many of which aren't even available on Udemy. But what I'm offering you today is a deal on the alert, because I really want to get you up and trading as quickly and confidently as possible. Look, knowledge is power, but if you don't put that knowledge to use, then really what's the benefit of learning all this stuff in the end? So to get you up and running as quickly as possible, I've created a code here, Basic Option FB1. Again, I want to make sure you're aware it's only for the basic alert. It's not going to apply to the Pro. But if you do this now, I'm offering $1 for the first month because I want to get you to try this alert system, see if it's something you can use and get you up and trading quickly. Just so you're aware, I do 2 to 3 alerts per week, 2 to 3 trades, and I also manage my profitable trades as well. So I send out alerts for the closing trades, for the profitable ones as well. 2 to 3 opening trades per week. So if you go there now, type in this basic option FB1 for the option basic trade alert, you will get it for $1 for the first month. After that, it'll automatically kick into $49 a month if you stick with it. But as you can see here, I want you to be aware you can cancel this at any time. You can stay for 1 month, you can stay for 6 months, whatever you find beneficial to you and your trading. But I want to at least give you the opportunity to see real trading in real time and how it's done. So again, as always, thank you for your support, and I hope to see you soon.